Hey guys, my name is Divyang Patel and welcome back to my channel Patel in Canada. If you are planning to buy your first house in Canada, then there is a good news for you. Recently, Canadian government has launched new tax-free first home saving account that is called FHSA. So today in this video, I will crack down all the details about FHSA account. I hope you will find this video valuable, so don't forget to like the video and subscribe to my channel. You can also watch my other videos related to first time home buyer guide. So without any further delays, let's begin now. So let's see what is tax-free first home saving account or FHSA. So FHSA account is designed by the Canadian government to help Canadians to buy their first home. This is a registered plan similar to RRSP and TFSA. In TFSA, your contribution as well as investment gains will remain tax-free, and in RRSP, your contribution are tax deductible and lowers your taxable income. So here in FHSA, you will get benefits of tax deductions as well as you do not have to pay any taxes on the growth generated by the investment in this account. However, keep in mind that you have to pay taxes if you withdraw the funds from this account to use somewhere else other than purchasing a home. If you would like to know more about RRSP and TFSA, then you can watch them by clicking the link mentioned in the description. So, if you are a first-time home buyer, then you can contribute up to $40,000 in this FHSA account, which can be used as a down payment to purchase the home. The maximum annual contribution limit for this account is $8,000, and the government launched this account on April 1st, 2023. So you can now open the FHSA account if you wish. Now, the eligibility to open this account is you must be a resident of Canada and at least 18 years of age. Also, you must be a first-time home buyer or you must not have owned a home in the last 4 years. Let's see the FHSA contribution limit. The annual limit to contribute in this account is $8,000. But if you do not make the full $8,000 contribution in 1 year, you can carry forward your unused contribution room to future years up to a maximum of $8,000 to use it in the next following year. For example, if you contribute $5,000 in 2023, you will be able to contribute the remaining $3,000 next year on top of your $8,000 contribution limit in 2024, which means you can contribute total of $11,000. After contributing the full $40,000, you cannot make further contributions. And after withdrawing the funds from your FHSA account, you must close the account by December 31st of the following year. Like the TFSA and RRSP, you can open multiple FHSA accounts with different financial institutions, but the available annual and lifetime maximum contribution limit will remain the same. Lastly, the account can be opened for up to 15 years, after which you must withdraw the fund from this account. You can find the details about your available FHSA participation room on your notice of assessment or reassessment after you have opened your FHSA. Another point here to keep in mind is that you are not permitted to participate directly in your spouse or common law partner's FHSA. That means only your spouse or common law partner can participate in their own FHSA, and only the holder of the FHSA account can claim the contributions as tax deductions on their income tax and benefit return. Now let's see the over contribution penalty rule. So generally you have to pay tax of 1% per month on the highest excess FHSA amount in that month, and you will continue to pay this monthly 1% tax until the excess FHSA amount is eliminated. Your excess FHSA amount will be reduced or eliminated by your new FHSA participation room on January 1st of the following year, or when you remove over contributed amount from your account. Now let's see what kind of investment you can hold in this account. So here you can hold variety of investment assets such as cash, stocks, ETF, GICs, mutual funds, and so on. My recommendation is, if you are looking at buying a home within 1 to 3 years, then high interest saving account or GIC is the safest option. You can open self-directed FHSA, or you can also open this account with banks, insurance companies, credit unions, and trust companies. Make sure that you choose the best investment option according to your house buying goal and risk tolerance. Now let's see the last point, what happens if you no longer need the money in your FHSA to buy a home. So in this case, you can transfer the funds to RRSP or Registered Retirement Income Fund, that is called RRIF, on a tax deferred basis. You are also not required to have contribution room in these accounts. If you withdraw FHSA for other purposes like non-qualifying withdrawal, then that amount will be included in your taxable income in that year, and you will have to pay the taxes. So that's all about FHSA. Thank you, and I hope you are receiving great valuable information about real estate and investment from my videos. So please don't forget to like and share the video. You can also subscribe to my channel if you would like to see this kind of great videos. Thank you again, and I will see you guys in my next video. Until then, see you and goodbye.